Hello, everyone, and welcome to Super Stock Brothers, episode number 18. Joining us today is Emmet Peppers, famous for having turned $30,000 into, depending on the podcast that I saw, either 30 million or 70 million. But clearly, we're talking at least 1,000x. And Emmet has built his wealth largely through very strong conviction in Tesla since, I believe, 2014. Is that right, Emmet?
2011, actually. Yeah.
Oh, wow. Yeah, very early. 2011. But last year in particular, Emmet, you had a monstrous year, it seems like, in particular through buying out of the money puts on QQQ, the Nasdaq Index, just before the stock market crashed due to COVID. And then you flipped that trade to long calls on key names like Tesla, Peloton, Square, and those types of companies.
Yes.
And today, Emmet, I know you started your own hedge fund called Good Soil Investment Management, which is your attempt to build a hedge fund in a new way. But I wanted to spend the bulk of our time today speaking to you on if you were starting out today or starting over today with, let's say you got zeroed somehow, how would you think about finding the next Tesla or turning, let's say, like a $6,000 Roth IRA in 2021 into $6 million somehow?
Yeah. Yeah, that's a tough one. I mean, if I want to be risky with it, I would probably look into NFTs and crypto, crypto and some of these new games, the play to earn category, where some of these games, whether Axie Infinity is the one a lot of people talked about, but I feel like there's a new generation of these games coming out, and maybe one or two of them will be a big hit, and 98% of them will probably fail. So I feel like I'd spend a lot of time researching that to try to find the next, 100x return on a few $1,000. But I'm not sure a Roth IRA could invest in that, to be honest. Right. So with the stock market, I'd probably I just try to stay curious about what the next biggest trend is that I think, and look for a small cap company, companies with market caps under 5 billion in market cap, and look for a company that's like part of a big trend, that's sort of a pure play on that trend versus something that has its is spread thin on a couple different trends. So I guess that's probably where I'd start. I don't know if that makes any sense.
Yeah, but and maybe even like talking about crypto, one of the things that I seem to have noticed is a little bit of I don't know, maybe this is just my own personal take, but when I think about a lot of especially the younger investors out there, it seems like, at least in my opinion, there's almost like this anger or desperation to try and get rich quick. And so I'm wondering how you would think about, in terms of like the philosophy or the thought process, like what should people's expectations be if you're trying to go for that next 1,000x, whether it's in terms of like even the potential to achieve that or the time frame in which to achieve that? Because I know for you, like you've been, I think you mentioned in Tesla since 2011, and you've kind of built this wealth over time. It's like that, like the overnight success, the huge success from last year, but it kind of built up over a decade. And so just wondering if you could speak to that aspect.
Yeah, I mean, for the first question, I think, if I was trying to get rich quick with, like you mentioned, a lot of people are doing, that's what I would do, focus on the crypto or play to earn, next big play to earn game hit or whatnot. But the chances of making 1,000x on that is very slim. I'd say it's better than 1 in 1,000, but it's probably not better than, it's much worse than probably like 1 in 10, or maybe even worse than 1 in 100. I don't know. But so you have to know that the odds are against you to try to get 1,000x return on something quick. That's for sure. And to kind of like, I guess for me, what I did, I had to be patient, and I didn't put all my eggs into one basket. I mean, I sort of did with my IRA account, my Roth IRA account at the time in 2011. I kind of, I had a side 401k plan with my job and a stock incentive plan with my job, and I kept those as like my retirement. And I had like a small Roth IRA account at the time. It was actually only like $3,000 at the time. And it wasn't a Roth IRA. Sorry, it was a traditional IRA, and it still is a traditional IRA. So that's unfortunate, but. It was a $3,000, but I didn't even put all my eggs. That was sort of like I thought of as like okay, I'm going to play with this money and try to see what I can do to maximize a return on this little pool of money, which was still meaningful to me at the time. And so when I discovered Tesla, I didn't, even though I thought it was going to be a next big thing, I didn't know the timing of that. Was it going to be a big, it was like a $25 stock at the time, like $2 billion or $3 billion market cap company at the time. And they had some roadsters they had delivered at a loss, and I saw the prototype of the Model S, and I just started developing conviction that I think this was going to be a huge stock in the next few years. I thought it was going to be a next big thing. I just didn't know the timing. Was it going to be 1 year or 3 years out? I wasn't sure. But instead of just buying the stock, like maybe I could have bought 100 shares of stock, right? And I was like, okay, if I buy 100 shares of stock, maybe it goes up 2 or 3 or 4x, and my $3,000 account goes to $10,000 or whatnot if I'm lucky over a few years. But I wanted to get something bigger, so I was like, with my job at the time at Interactive Brokers, it's very options centric, and I knew about long-term call options, and I'd read an article about it, and it just made sense to me. I looked at the long-term call option prices for Tesla, but they only extended out like a year or 18 months out into the future, and so I didn't want to put all my eggs in the basket of buying long-term call options for just 18 months from there. So I put like half the money into long-term call options that would expire in 18 months, and I saved the other half to, invest more if those were going to expire out of the money, which I ended up doing. The first set of call options I had, I think, were expiring in 2012. Maybe I found it in 2010, because the first set of call options I had expired in 2012, like worthless. Then I bought more call options that were going to expire in like 2014, I think, after that. And those are the ones that went up a lot of money after the stock initially broke out in 2013 and 2014. So I had to be patient, and things don't work out in 1 or 2 years. Sometimes it takes 4 or 5 years for if you find a company you think that is the next big thing, it could take several years for the market to really appreciate it, and the stock to sort of get like re-rated, is what they call it, I guess, some of these analysts.
Right. And so it kind of sounds like the way that you were approaching investment is, so I assume you were long some portion of Tesla, and then you had those, I guess, longer term call options on Tesla. And so is that kind of how you were viewing your investment kind of strategy, in terms of having like, just kind of long safe, and then just kind of being a little bit riskier with another pool of money? Is that how you kind of think of it?
Yeah, so my 401k and my stock incentive plan at work, that was like my safe retirement plan. I wasn't touching that. And then that $3,000 IRA account, I was being very risky, buying pretty much exclusively long-term call options, no stock. I thought about buying stock. If I bought stock, the return might be 3 or 4x, but if I played the options right, I'd get like a 50x return, I realized. So I thought I could try to take a stab at playing the options right, and that the market eventually would, bring the stock way up to $50 or $100 plus, which it did eventually.
Right. And sounds like it's probably more tax efficient to be betting with your IRA money.
Yeah. If you have a big win like that, it's more efficient for sure. Yeah.
Right. And just speaking of different types of trades, so as you're mentioning, you're kind of taking some risks. So it's not like you were just relying on the long hodl. So you used long dated call options on Tesla, the leaps. In the case of your bet on COVID, you bought, seems like fairly short term, kind of far out of the money puts. And so are those in terms of your risky or risk on plays, are those your two primary plays in your playbook, or are there any other trading strategy that you've used or you're thinking of using to kind of drive that higher growth for the risky part of your portfolio?
Yeah, I mean, I look at calls and options, and you can do so many fancy and sophisticated things with calls and put options. I try to keep it simple and just think of them as levered instruments to get sort of a magnified return on a movement of a stock or an index, whether it's a short-term or long-term option play. And so that's how I use them. I don't do any spreads really. I don't do any iron condors. People do. I don't do vol trading with options in stock. I don't do anything fancy. You can do so many fancy things with it. So I look at a stock market cap, and sometimes I buy short-term call options too if I think a stock's going to go up in the near term off some news. I'm wrong a lot of times. Don't get me. I'm not right all the times. We're highlighting two of my bigger successes, obviously, but I'm probably wrong more often than I am right. But when I'm right, I make 10x or more a lot of times. So I sort of look for opportunities that I think have at least maybe a 20% chance of panning out in my favor. So even if I think it's unprobable, like the S&P 500 index inclusion for Tesla, I bought kind of short-term call options on that. I'm not sure if you saw those interviews I did with Dave Lee about that kind of big move. But that was, 2 or 3 months out, call options. As soon as the S&P announced inclusion with Tesla, I think I bought the 700 strike call options for January expiry when the stock had gone up to $450 the next day already. And, I ended up selling those around $870. So I bought them for, I think, like $7 or $8 or $6 and sold them for $170. So it was a big win, and it was a 3-month call option, and but I didn't think that was a probable outcome. I thought it was maybe like a 30 or 40% chance outcome that Tesla went up to around $800 a share by mid-January after that inclusion. I thought it was probably the trade was going to lose altogether. I wasn't sure if it was going to go above $700 at all. But I thought when I looked at for example, the Interactive Brokers Probability Lab, if you use that, it shows you where the options pricings are for a stock at a certain time period, and it shows you what the probability is based on the current market prices of the options of that stock for those time periods. And if I looked at the Probability Lab, and the Probability Lab was saying it's only a 5 or 7 or 8% chance that Tesla was going to get to $700 a share by January, that 3 months later. And I was like, I think it's way higher than 5 or 10% chance. I think it's like a 25 or 30% chance or 40% chance maybe. So I put a lot of money down on that trade because of that probability discrepancy I saw between what the market is pricing as a probability based on the options versus what I thought. And luckily it worked in my favor in that case, right? So a lot of times, even if I think it's less than 50% chance, I might lose everything. But if I'm right, 1 out of 5 times or more, I can have huge wins,
Right. And it seems like that's where there is some opportunity where, for example, when you talk about the pricing of options, it's generally done through some assessment on volatility, right? So whether it's Black-Scholes model or some other model that's being used to price those options, but then there could be something, whether it's like the inclusion in the S&P 500 or whether it's like the potential for a company to get acquired or not, which is not tied to vol. So in that case, then we do see like these kind of opportunities where as someone with some insight, you could potentially have a mispricing of options. Is that, would you say that would you agree with that assessment?
Yeah, and just before we kind of go too far into this theory, make sure everyone watching this knows this is not advice in any way by either of us. This is just our own thoughts and opinions on this. We're not advisors advising anyone. But yes, I agree that if you have some insight, you think the market is not pricing it in, and you have to. I think a lot of times the market is pricing it in. Like I tried to short Nikola. I tried to buy Nikola puts. When Nikola was at its height, when it was like up to $70 or $80 a share back in June of 2020, and the puts were super expensive though, so the market was kind of pricing in. I bought them like 3 weeks out for like $50 strikes prices, and it was like at $80. I was like, this thing's coming way back down quick, I bet. And I bought them for like, I don't know, it was like $2 or $3. It was like 2 weeks out actually, and the stock came down to like in the 60s, low 60s or high 50s, like the week of my expiration, but it didn't get below $50 until like the week or two after that. And so I mistimed it, and those puts were expensive, So a lot of times the market is pricing in, I think, the probabilities, and that's why I like, instead of me trying to figure out in my own spreadsheet, like for example, Interactive Brokers has this incredible tool called the Probability Lab. I've talked about it a number of times, and you pull that up. It's free to use. If you can open up a simulated account for free on Interactive Brokers. You don't have to open an account with them, and then you can get access to their Probability Lab and pull it up for any stock and see. It just automatically calculates the probabilities that not Interactive Brokers isn't calculating. I mean, it's using a formula to show you what the probability based on the options pricings are. And so, yeah, if the market makers and the Black-Scholes model or the derivative of the Black-Scholes that people are using, the binary version or whatnot, if that doesn't have enough implied volatility built into it, for example, for an event that you think should, then you'll see a mispricing, and that's where those advantages can be big. So, I mean, I think if you study a couple of stocks very carefully, and you can spot those kind of implied volatility events before the market, or if the market's not doing it with the options pricing, then that's kind of where those discrepancies or opportunities lie, I think.
Okay. So I want to get back to like specific opportunities, whether it's stocks or, NFTs, but just talking stocks for a minute. But so in speaking about, one of the names that you have, you've made a lot of money on, and I think you're largely invested still in Tesla, which is sitting at a close to, 200x gain from IPO in 2010. And I no doubt many Tesla faithful still think there's at least another 10x, say, left in Tesla. But when you're thinking about the next Tesla, I mean, what are the other companies that you would say could potentially be capable of 1,000x, which is, very likely something that Tesla's going to achieve? And the other question, kind of like the follow-on question to that is, maybe do you think that maybe Tesla is unique? Is Elon Musk and Tesla sort of a once-in-a-generation type of opportunity, or are there others? What do you think?
Yeah, I think Tesla is absolutely a once-in-a-generation company, even bigger. It might be the biggest company of all time when all is said and done pretty soon. I'm pretty highly convicted by the end of this decade it'll be the largest company out there, and most people will probably realize it's the biggest company of history we've ever had. So Tesla is very unique, but it is, like you said, it's huge already. It's close to $800 billion market cap right now. Even above that if you count their diluted shares that will happen in the future. So, for it to be a 10x from here, it's going to have to be an $8 trillion market cap company. I think Apple's like $3 trillion or $2.5 trillion or something like that. So I do see Tesla getting that big, by the end of the decade for sure. And that would be like a 10x, but 100x would mean 80 trillion. I mean, that's kind of hard to believe or fathom. I mean, I'm not saying it's impossible, but that might be like 2040 or 2050 or something. I don't know. I mean, it just seems hard to fathom that kind of return. So, to get that type of 100x return, I'm not sure 1,000x return is, I have no idea to spot those companies, to be honest. I'm lucky Tesla I was early with Tesla. When I first invested in Tesla, I didn't see it being 1,000x. I didn't see it getting to be $1 trillion market cap company like in my wildest dreams. Not until 2014, 2015 did I start thinking maybe it could become $1 trillion market cap company one day in the future. But I didn't think it would be this soon. But when I first spotted Tesla in 2011, I was like, oh, 2 or 3 billion market cap. I think this could be like a 20 or 30 billion market cap, which would be like a 10x return. So that's, for my mind, I have to think 10x. I can't think 100x. That's a little too, crazy for me to like think that way with any conviction. So I can really go 10x at a time. I feel like and sort of start developing conviction. So I look for smaller market cap companies, right? The smaller the market cap, the easier, with a big total addressable market. So smaller market cap companies with a big total addressable market, and they have to have some kind of competitive advantage that you think is going to prove them to be a 10x return in that market, in that total addressable market, that they're involved in. So, for example, Lemonade, I've talked about that a number of times publicly. I think they're an insurtech play. There's lots of insurance companies out there, and there's some insurtech companies out there. But I think Lemonade is unique in certain ways, and I've started to develop conviction on them. They're like around a 4 billion market cap, but I could see them getting to like a 20 billion market cap, maybe 30 or 40 if they're really successful in 5 years. So that's like a smaller market cap company that, if they really succeed, could return 10x, but it's a big if, right?
Right.
Roblox, that's around 45 or 50. And I love your podcast. I know you guys talked in depth about Roblox a few episodes ago. Yeah, I like that. But they're around 50 billion market cap right now, or 45 billion. So to be a 10x, they're going to have to get to like 500 billion market cap, right? But if they have if they have even like a small slice of the metaverse in 5 years, I think that could be a 500 billion market cap company. So the metaverse means lots of things, lots of people. It's a very commonly used word. But if they're part of that future that we're moving into, and they have the sustaining flywheel growth they have now continue with developers, with greater content to bring more users, to bring more developers with greater content, and to keep that going, I could see them being a 10x return in 5 years too. So that's, going from 50 billion to 500 billion is easier for me to conceptualize than 800 billion to 8 trillion, unless I know Tesla very well. So trying to conceptualize, Apple to go from 3 trillion to 30 trillion, it seems impossible to me. Or, anything that's our big company in hundreds of billions of market cap already. Facebook, Square. I don't think Square can 10x, and maybe it can, but I just don't have the conviction that it'll go up to $1 trillion market cap in the next few years.
Right. And so when you're developing conviction, and say like the first two companies you mentioned, Lemonade and Roblox, what is it about those companies in particular that made you feel more comfortable investing in those companies versus other companies? Is it the market size and like the relative potential in terms of, well, I think it's this size and it can get to that size? Is it, did you do the level of product investigation that you did on Tesla with these companies? Or like, how are you kind of making your decisions on some of these companies today?
Yeah, so it's a little bit of all of that, including the founders. I think I'm a big believer in trying to understand the founder. There's some other stocks that we'll be going public with soon that we're heavily involved. We're starting to take heavy positions in that I think could be, 5 or 10x returns, because not just Roblox and Lemonade. We think there has to be some kind of advantage, some kind of unique advantage to the company, and it has to have a big total addressable market. And so Lemonade and SureTech, we think that there's fintech companies out there. Everyone knows about fintech companies, Robinhood, all these fintech companies out there. But and Interactive Brokers, I know the fintech space very well from my previous job. And Interactive Brokers succeeded, very well in the last 10 or 20 years. Because it built its own backbone infrastructure. It wasn't trying to white label other brokers, other dyno brokers infrastructure and just show a nice glossy user interface, but be kind of stuck behind a dinosaur backbone infrastructure of clearing and settlements and all that. They built their own A to Z kind of infrastructure. And so Interactive Brokers succeeded to where it's gotten despite a bad user interface, right? So Interactive has a terrible user interface, user experience for the most part, but it's been able to be so cost effective and safe to use and reliable and offer great technology for people that know how to learn how to use technology, that it's still succeeded. And then you have Robinhood on the other side of the fintech world, which has it sells the order flow, which is kind of nasty in a way to do, and some people love it. I don't know, it traps a lot of people into coming to the brokerage world, I guess, and but they have a really nice user interface, and they've been able to exceed because they have a really nice user interface primarily that's like mobile and all that. And so I see Lemonade in the insurance tech or the insurtech space is like a combination of the two. Like you have this amazing interface that people love with Lemonade, plus the only insurtech play I know that's kind of building their own infrastructure, except for life insurance. I think they kind of use some other insurance provider they step off of for that. But for their other insurance products, they're building their own version so they can be nimble, they can adjust, they can become global more quickly instead of just from one country, So there's a lot of advantages in that, and that's the only insurtech play I know that's doing that. So that's why I like Lemonade, and they're only a 4 billion market cap. I mean, they have to succeed very strongly, but I could see them growing and taking a lot of market share in the next 5 years. But it's not a given; it's a risk, for sure.
Right.
But to me, the risk, the potential rewards outweigh the benefit, the costs of that risk. And then, what was the other one? Roblox. The founders, I've gotten to know. I've listened to a lot of the interviews. Dave Bazook, I can't remember his last name. I can't pronounce it. But I think he's very vested in a long-term vision, and so he's not just trying to maximize shareholder value quarter over quarter. He's a veteran. He's already multi-billionaire. He's not some kind of younger guy that's just trying to get rich quick with the newest game they developed or whatnot. They're actually like a platform. I think of Roblox as kind of like this platform, sort of like the Apple iPhone App Store is a platform. So they built this platform for developers and younger people that want to do gaming or social experiences to meet on. And I think it's like this. They've had this self-fulfilling, viral loop going that's gotten so big that it's hard for anyone new to come in and compete. You have Sandbox or Steam, people say, and I think those are interesting examples of potential competitors. But for example, Steam, like, I don't know how to use that. I think I tried to log into it once on my laptop when I got my first Oculus, and I got lost pretty quickly on how to like integrate stuff. Like Roblox is a simple app. You press a button. Even my parents, my kids' grandparents can press a button on their phone and just start instantly, connecting with their kids without having to learn some new coding or figure out what files should be going to what place. So just the simplicity of Roblox combined with that viral loop, I just don't see any competition for that.
And I think the other thing that not everyone realizes is from the developer perspective, one of the things that Roblox enables you to do is to widen the developer ecosystem, meaning like they take care of so much in terms of back-end infrastructure, as well as the ability to create a game. So that, let's say the development vector, that cost, they compress it significantly. So somebody can go from idea to game in a much faster cycle with much less cost and with less people. So, I think that's the other thing that they enable. But, I'm not as bullish as you on Roblox, but I definitely agree that they've got a lot of incredible benefits to their platform, and they've done an incredible job.
Yeah.
So maybe the one other another question I wanted to ask you, just from like a trading perspective, has more to do with like the macro environment, like let's say the economy, and how do things like the level of U.S. debt, the monetization by the Fed, and all the money printing that's going on, fears of inflation, conflicts between U.S. and China, the notion that we may be shifting from to a fundamentally lower vol environment, for example, all these kind of like macro things happening in the world. How does that impact your trading strategy, if at all? And are there things that you're watching against some of that stuff, whether it's like MTU money supply or the VIX or anything like that? Like, how does that influence you?
Yeah. So with macro, markets, the only thing I've ever gotten right really with the macro markets, I would say, is the COVID crash, kind of predicting that to some degree. And, for that, I was kind of following what I call citizen journalism, or what people call citizen journalism, trying to find sort of semi-reliable sources on the ground, reporting on Twitter or social media, from China, and then later from I think it was Iran and Italy, where it hit next. And so what I was seeing there, I didn't see being reported in mainstream media much, or taken into as much consideration in mainstream media here in the U.S. And so, I try to find discrepancies between mainstream media and citizen journalism, because I think there's a lot more truth in citizen journalism. And if there's something growing like the COVID, plague or whatever it was, like I didn't know what it was. It scared me. I was like, weeks, when I put on those puts, I also went to like Target and was buying up a bunch of, not toilet paper, unfortunately, but I bought like medicine for my kids and,
Right.
And stuff like that. And just because I thought there could be a run on stuff or whatnot. But I'm not a doomsday prepper at all. But I was, from this citizen journalism, I realized like once this thing gets to the U.S. and the first major city starts, showing, lots of deaths and people in body bags, then I think that's going to be mass fear, and that's the time to close my position. So, it's sort of like that Warren Buffett saying, you want to sell. What is it? I think you want to short.
Be fearful when people are greedy, and greedy when people are fearful.
Yeah, buying people are fearful. So when the mass fear index gets the most, I thought it would be when there's like news reports of like some major cities showing mass graves or whatever. And that was in New York happened, and I think that was in April sometime. I just closed out my position for a nice return. I waited another like few weeks before to make sure the market was kind of settled before I used those proceeds to buy long-term options on growth stocks or whatnot. But so that was the only big macro market event I really predicted well. And the first time I tried it, I actually failed. So I thought at the end of January that this COVID crash was coming soon, like in a few weeks. And I bought a bunch of these puts, and those expired worthless. And so in mid-February, I re-upped it, and I was still convicted, like this is still coming. And I, instead of a few weeks out, I bought them like 2 months out, or February, March to like mid-April or something, or end of April to like expiry. And so I was a little more, and that time it hit, and the market did crash 30 or 40% or something, the Nasdaq. And so, that was the only time I got a macro crash. There's been other times I've been wrong on macro market crashes. I think in 2015 or 16, I had a huge Tesla position that was sort of levered because I had all these options that expired way in the money. I exercised or took assignment to take shares. So I had these shares on margin, and I didn't want to sell them because the tax consequences were enormous. And I'm watching the market, and there's like all this talk and fear talk about like a budget not being passed and the government going bankrupt, and it got to me, and I was like, oh, it was like the talk of the town and all the financial media. And I bought a whole bunch of puts like 2 weeks out because it was like the next 2 weeks the market was going to crash because the budget wasn't going to pass or something. It was like everyone thought that, and they were expensive puts because it was implied in the price, and those turned out to be worthless. I lost like 5 or 10% of my portfolio value just trying to put that trade on, and didn't get it back. So I've lost out on these bets when the market's going to crash. So I learned my lesson that like it's very hard to predict macro market stuff. There's always going to be fear talk, and in the current environment, we're at this new environment of like interest rates being, I think, indefinitely low for probably forever going forward. I can't see interest rates coming back up above like 2% or 3%, maybe 3% possibly, but not above that any meaningful amount for any meaningful time like ever again. In the 80s and 90s, things were at like 5-10%, and I don't think that's ever coming back. So I think we're kind of at this point, this new era where modern monetary theory is kind of taken over, and the Fed can just print a lot of money as kind of a secret way to tax the people. But at the same time, it's offset by deflation of technology accelerating in certain areas. So, it's kind of a weird dance I think the government is doing and can get away with for a while and maybe for a long time. So, there's always been talk in the history of economies and major civilizations, I'm sure, and, that the government's taking too much from taxes, or the fiat currency is being mistreated, or, being inflated or whatever by the government. And so you're always going to have lots of fear mongering around that, I think, too. So you have to keep that in mind.
Right. And maybe I could ask you about if you are going to be betting on an event like the bet you made around COVID, how would you investigate, research, form opinion on that? And just taking like maybe a couple of real world examples today. So right now there's all this stuff happening with the Chinese government, right? And so they disappeared Jack Ma, the CEO of Alibaba, for a while. They've got all these restrictions on like kids playing games. They're probably going to nationalize, or there was a rumor they're going to nationalize Didi. But there's like the hammer's kind of getting cracked down in China on Chinese tech. And then some people are even talking about even the structure in which like foreign investors can invest into China through a VIE structure. Maybe that even goes away, which theoretically, and I own Alibaba, but like theoretically, if they got rid of VIE, I mean that could go to zero. And so if I were to try to think about, is this like the height of fear right now, and maybe I should buy some leaps on some Chinese tech companies or something like that, or like, so that would be one example of where I would be asking you, how would you think about that or research it? Does your process look like? Or even something different, like in the biotech space, we've got all this new technology in terms of mRNA, all the AlphaFold stuff. I think Google just like gave it away or something like that. But like, we've got all these new technologies potentially impacting biotech companies. How would you, I'm just trying to understand, like, if you were going to look at one of these things, if you were going to pick an area,
Yeah.
what would your process look at to investigate and then try to form an opinion on some of these things for an investment strategy?
Yeah. So first off, I currently don't have a strong opinion on one of those things. I haven't had enough
Okay.
time to like
Okay.
focus. But if I did have time to really try to focus on those things, I think that's what you're asking,
Yeah.
then
Yeah.
I'd make myself kind of get obsessed about it and very curious about it to the point where I'm like trying to find out who are the key respected people on social media on these particular niche topics. What's their record or track record? I try to read between the lines. Look for quotes of Chinese officials, for example. What are their quotes? Is there anything in between the lines? Because media articles, that's almost like misinformation because you have these
Right.
opinions of
Right.
these, whether they know it or not, everyone's biased, but the reporters, they're just kind of like people on the low end of the totem pole of these corporate structures that report news, and they're writing their opinions into these articles. But really, it's the quotes you have to pay attention to. So whenever I'm trying to research something, I'm looking for quotes of the people that I think are important. I'm not reading
Okay.
headlines of articles. I'm not reading anything else. I just scan through and look for the quotes. And then I look for outside of that, I look for respected people, whether it's like Nassim Taleb, for example, he was, talking about the risks of the COVID crash, for example, and tail risks with that and stuff. So he's a smart guy in a lot of macro market stuff, tail risks and stuff, but it doesn't mean he knows everything, So you look for people like that, but you also have to be careful to spot the BS because there are certain people out there that talk very smart. And I talked about it in a recent, one of my recent channels, and I even brought up on Twitter. There was this lady who was being interviewed. She's well respected on Wall Street. She's got like 100,000 Twitter followers, and she's talking. I was listening to her interview. Someone asked me to listen to her interview to see what my thoughts were, her and hers, about Roblox and Tesla. And when the interviewer, she sounded so smart about NVIDIA and all these other things that I'm not a super expert on, but I was totally believing her and like, oh, she sounds smart. Maybe she's one of these signal providers that I should follow and listen. But then when she started talking about Tesla, for example, it was so offbeat. She was like, yeah, for Tesla to reach full self-driving, they're going to have to wait till they get 5G connectivity for edge computing and blah, blah, blah. And I was like, what? And I know enough about Tesla where it's like a litmus test for me, where,
Right.
if you're an expert on one thing that everyone can comment on, you can kind of use that one thing as a litmus test to see what everyone else is saying about that and say, hey, it's okay if the person doesn't know about it, but if they talk like they do know about it and they're completely wrong on it, then that's like, oh, stay away from that person because they're going to be talking like they know about everything and they could be completely wrong about everything, So it's sort of like you have to be able to spot the BS and use your own tools and instincts to figure that out, if that makes sense. So you got to know what's signal versus what's noise, and it's not easy.
Okay. And maybe we could talk now about what you're doing now with Good Soil Investment Management. I mean, structurally, I definitely want to applaud you for how you've kind of structured fees differently. But can you talk a little bit more about the motivation behind Good Soil as well as like the fee structure?
Yeah. So when I worked, I was in sales at Interactive Brokers I was working for the Interactive Brokers 13 years, sales for the last 10 years of my career. I left that job in end of October of 2020 to start Good Soil Investment Management. And 2020, as we talked about, was a tremendous year for me in personal investing with the COVID crash, Tesla, buying at the low after the COVID crash and having all my Tesla positions go up a lot and so forth. So my personal wealth jumped from, what I was hoping to retire at by the time 60 or 65, to suddenly I could retire now and have a lot of extra money too. And it jumped like multiple levels. So I was always waiting for Tesla to go up to like $1,000, pre-split, so I could potentially retire and start my own little hedge fund with a few $1,000,000 and because that's who I'd been servicing at Interactive Brokers as a prime brokerage sales guy. Lots of startup hedge funds. I knew that business well. I knew how to do it, how to start a hedge fund at least. And, stock picks is a whole different thing, but the operational, processes, I knew how to do that. And so, I thought of that as like my next step forward in my career to kind of like make more money. But when my personal wealth jumped like 2 or 3 levels in 1 year, at the same time when you didn't know the world was crashing, it was kind of a crazy, you didn't know how deadly this COVID thing was. Is it going to kill like a quarter of the people who get it long term, or is it just 2% of the people who get it, or what? You didn't know, So it was kind of a scary year, most of that year, and I really had to pray on it, and I didn't want to just start a hedge fund to make more money. I had enough money at that time for me and my family, and I was like, maybe I'll start a restaurant or do something else, because I'm into nutrition, and I think, there's a big obesity epidemic in Western society that really is crippling us. And so I wasn't sure. And so I had to really like think about it and wait and prayed on it. And I realized, maybe if I do have some God-given ability to spot investment returns or opportunities that others don't, maybe I should do something good with it instead of just increase my own family's wealth. Maybe I can actually start that hedge fund and do something different to change, society or help society's future and such. And so I realized, okay, there's something called the parable of the sower in the New Testament or whatever, and it's like the seed that falls on the good soil has 50 or 100x returns. Right. And I was like, oh, that reminds me of some of my returns and my investing in my outlook of what I'd look for. And so I thought of good soil investment management, and I said, okay, I'm going to have half of the fees, half of the performance and management fees go to charity, and I'm going to put that in the offering memorandum. And my hope is, best case is if our fund does very well over the long run, we're not just making money for our investors, we're actually, being an example for altruistic capitalism, which I think is the next, evolution of capitalism. There needs to be an altruistic aspect built into it before it gets taken over by kind of radical socialists, especially the younger generations, because I think that would destroy society as we know it, as we've seen in other countries that have gone socialist, So I think, and hedge fund managers and Wall Street are seen as like the most greedy capitalist pigs, right? So if you can be a really successful hedge fund manager, but now you're giving half your fees to charities, you can't be hated so much, right? Maybe other hedge fund managers see that example if we do really well and say, okay, let's do something different and say 10 or 20 or 30 or 50% of our fees go to charity too. And so maybe a trend can be, I'm not the first one doing this. There's actually a few other people that have done something similar, I think, but they're, no one succeeded wildly yet. So that's my hope. That's what keeps me going, is not just to make more money, but to kind of help inspire this new trend of capitalism, if that makes sense.
And can you speak to the trading strategies you're going to deploy? Is it similar to the stuff you've been doing for the past decade?
Yes.
Okay.
Yeah, it's very risky. So we have a very high minimum for our fund, and we make sure that we don't want more than 10% of someone's net worth to be put into our fund, because we know our strategies, our investment plays are very risky, and it's possible the fund gets cut in half one quarter to the next, and I'd hate to see someone's, meaningful, more than 10% of someone's net worth that they, are hoping is going to grow into something big, get cut in half, and that'd be stressful for me. So I want to make sure it's if someone wants to invest in our fund, that it's something that they know themselves is so risky that they can only put 10% of their net worth in at the most, So it's risky. We try to keep it risky. Sometimes we want to be safe, but we have to remind ourselves this fund is kind of, it's 15 or 20% of my own net worth is actually in it personally too. And we look for the opportunities that we think have outsized returns. A lot of times they're opportunities we think is likely to fail, but if it doesn't fail, it'll have a 5x or 10x return possibility. So that's what we're doing. It had a great, in 2020, I had it set up as an incubator account, so it was just my own wealth, and it had an incredible return that's audited, and it's on our website and so forth. Yeah, but we didn't start taking investor capital until February of 2021. And so since we've taken this 2021 has been a harder year. We're sort of flattish, but we think we're positioned well to finish the year strong, hopefully, and have an exciting 2022. So we'll see.
Awesome. All right. So, those are all the questions that I have, but maybe I could kind of squeeze one last question in here, since you're, one of the key people talking about Tesla and thinking about Tesla. Maybe my last question here could just be about Tesla in terms of like, what do you think is next? Obviously there's like full self-driving and all that kind of stuff, but like next beyond that, I know like Dave Lee did a talk about maybe they become like the next Amazon, I forgot what he called it, last foot commerce or whatever.
Foot. Yeah.
But like for you personally, do you think that there's like another card up Elon's sleeve? I personally wish he would go into crypto and create a Tesla coin and then become like Tesla based. But I don't know if you have any thoughts in terms of like what you think is next.
Yeah. I do think they have lots of cards up their sleeves. There's a lot of like call options, so to say, embedded call option businesses embedded within Tesla. I think the biggest opportunities are this AI, this Tesla bot, Teslanoid is what I call it.
Oh, right.
They just revealed that's more like 5 years out. But imagine when they didn't have a functional pro. He said next year they'll have a functional prototype. So even if his timeline's off, it's
Right.
2 years from now they have a functional prototype. They'll probably start taking orders at the same time they show the prototype. You could imagine, and imagine
Right.
what that order backlog is going to be. They're going to be like, all right, let's say this AI bot, Tesla bot is going to be, maybe
Yeah.
they're aiming to deliver them in 2025 even or something. I'm going to
Right.
order a bunch of those for May. Everyone's going to order as many, as long as it's not like
Right.
$100,000 a bot. If it's like 10 or 20 or $30,000, or maybe it's 50,000, I don't know, but people are going to
Yeah.
be ordering them like crazy. And
Right. Right.
I'm not even sure Tesla's going to sell them. I could see Tesla just produce them, use it for themselves, and maybe lease them out to people, and you pay like, a few $100 a month for this bot. But basically, that's from their real world AI that gets to, applications from neural networks and neural network training that they're developing with this Dojo capability, Dojo computer capability. So that's the big thing for Tesla. Beyond that, something simpler that I think could be big for Tesla the second half of this decade is supersonic eVTOLs, electric vehicle takeoff and landing vehicles.
Yeah, I
The
think he spoke
supersonic
about
jet.
that on Joe Rogan, right?
Yeah, and he's mentioned it before. I follow
Yeah.
every one of Elon's interviews for the last 10 years,
Right.
and I've seen them all and heard them all. And he's mentioned it sporadically, and I think he mentioned it once on like what was it, Dave Letterman or something like that, or Jon Stewart show or something.
Right.
But he's talked about it. He's got a design in mind for that, and he's just, I think, waiting for the energy density to get to a certain level where I think he's going to fire that design up more, and that's probably going to be the next few years. And that could really, like, I'm talking like not flying cars. That's not a business, I don't think. There's lots of these flying car companies saying, "Hey, we're eVTOLs or whatever." But this is like a jet that goes way up into the sky, thousands of feet up, a couple miles up high or whatever, maybe more, really quickly, and then it just zips through the air really fast, 500 or 800 miles to a destination and lands vertically. It's like a jet, like an actual, but it's much more efficient. It's going to be much more cost effective, and I think it's going to displace the current airline industry to a large degree. It has the potential to do that. That could be a huge catalyst for the second half of the decade going into the 2030s that no one is even thinking about, I think.
Right. All right, Emmett. Well, I want to thank you so much for your time, and definitely appreciate you talking to me.
Yeah,
But,
no, appreciate it. I love your show. You guys do some really good interviews. Hopefully, I think you guys are, good quality stuff. I'll certainly retweet this and try to get you guys more exposure, because I know your other interviews have been very informative for me, at least.
Awesome. All right. Again, thanks again, Emmett, and for everyone else, we'll catch you next time. Bye, everybody.
Right.